the metrics are there to make sure it's apples to apples. So you're looking at the right numbers to compare. You know what your goal is or what you want to happen. The metrics are here to tell you if this would or would not accomplish those goals.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. Welcome into another episode of the Get Invested podcast with your hosts, Jordan and Matthias. As always, we're excited to be here to talk all things investing, real estate, and real estate investing. Today, this is going to be part one of two. We're going to do part one, part two of investment metrics, the kinds of things that you project with and or assess how successful an investment will be. Part one is going to be total return, average annual return, and equity multiple. And we're kind of give the foundation of how you would essentially read these in the first place. And then part two, we're coming back with IRR, internal rate of return, cash on cash, and its connection to preferred return and what that is. So just going to set that up here now before we launch into the first half, which is kind of the basics: average annual return, total return, and equity multiple. All right. So I'm just getting right down to it, Matthias. Let's go.
Yeah, I think every now and then it's good to take a step back and go back to the kind of the basics, the building blocks, the learning the language of what we're talking about. Because it's almost like my old days in the military when, we talk in all this jargon and acronyms and stuff that nobody has any idea what we're talking about. We want to make sure that it makes sense to people, especially as we're educational, so we're trying to teach people how to understand this type of investing. And then the metrics are how you kind of evaluate one versus the other, or even compare it to other types of investment that you are familiar with or that you've heard of. So starting off with where you're going to find these, right? So you're going to find these in somebody will give it, they call it a pitch deck, they call it investment summary, property overview. There's all sorts of different names for it. Basically, the business plan. Think of it as the business plan. In our type of investing, you're going to be presented with a business plan, and it'll have certain metrics on there. Some operators or syndicators who do what I do, everybody has their own kind of preferred method and metrics that they use to present, but these pretty much have to be in there because they're the biggest ones that anybody's going to talk about, the ones that we're going to discuss in part one and two. So basically, you're going to find this in whatever they present to you. But your job as an investor and my job as an investor, when I'm presented with one of these, is to understand what they're projecting in terms of returns, that the metrics we're going to go over. But almost even bigger is to evaluate how they got to those numbers, right? We always talk about conservative underwriting, what needs to happen in order to make these metrics. For us, we always anticipate that things are going to go way worse than we expect them to go. We write that into our projections to get our numbers. Not everybody's going to have that approach. So it's important for every investor to look and give a critical eye to the metrics that are presented and make sure that you understand how they got to those projections. What inputs did they put into their calculations that got them to these projections? Because, like I always say, if everything has to go right to make these projections, then that's a pretty rough investment. I wouldn't be making those because nothing ever goes according to plan, especially in this business. We know better than most. So I just want to put that out there. You're going to be, go ahead.
Oh, no, I was just saying, I think that's a great place to start as just context. And we've talked about it before, but like you said, well, so first of all, just all the way back, absolutely, review is key. And also, in case other people haven't gone back to literally one of our first episodes, which was probably not very good, there's that as well. But I will say, first of all, review or just a refresher, because I got to say, even if you're in it or you've been doing it for a while, every once in a while you'd be like, wait a second, now, how do you calculate? Do you carry the one? Like, what is this? You got to think about it for a second. So to become fluent, right? It takes a minute.
Yeah.
And then secondly,
it's my day job. It is not everybody else's day job. So they don't look at it as often as I do. You know what I mean?
And then secondly, yes, that I have an issue with the phrase numbers don't lie, because I think that's complete nonsense. And
you can make numbers lie very easily.
Yeah, exactly. So putting that aside, even if you want to argue with that stark of a phrase, it's definitely true that numbers can tell different stories. The same numbers can tell different stories.
True.
So it's very important, like you said, to understand how they arrived. Knowing the definition and knowing what this is saying is different than knowing how they got to what they're saying. So that's a very, very key point to kind of start off with before we talk about them in a more kind of basic way.
Yeah, and so I mean, we're not really going to talk about how we get to these numbers in this episode. You can go back and check out. We have plenty of newsletters and podcasts about the act of underwriting and how our philosophy of underwriting and how we do that. But today we are going to get back to the basics of just going over the individual metrics that we kind of put on all of our paperwork and the industry standards that everybody's going to put on their paperwork as well. Okay, so for total return, it actually goes hand in hand with equity multiple, and we'll kind of get into the math of it a little bit. It's not complicated, but basically total return is, and it's percentage. Total return is a percentage, is what do you expect to make for the whole investment. There's going to be different parts and different ways that you make this total return, but add up all the money that you've invested and then add up all the money that comes back from the investment. And that is the total return metric, right? So you're going, hey, this will get me X percentage based on my initial investment. Now let's pull up the website here, our website, where we discuss a little bit of this stuff too. We have our
just plug our
super easy
investment terminology and frequently asked questions part on our website, which if you're someone who's new to this, I have gone through each of these investment terms and these frequently asked questions and attached either an episode that we've done of the podcast or an article we've written or both that speak to these questions in greater detail than what we can write on the website. So right now on total return, here's our example.
Okay. So basically, let's say that we make an investment of $10,000 and we get at the end of the investment, let's say it was however many years. At the end, we have calculated all the money that was sent back to us, and it equals $20,000. Timeline doesn't matter for this particular metric, so it could be as many years or as few years, doesn't matter. We started with 10,000, they send us back 20,000. That's 100% return. Effectively, we doubled our money, right? So what that does is that tells you can expect that at the completion of the business plan, it projects that you'll have 100% return. Going over to the equity multiple, it's almost exactly the same. It's just described a different way or put in a different way. So if you have a $10,000 investment and then at the end you have a stack of cash equaling $20,000, doesn't matter how it came back, then you have doubled your money. So your equity multiple is 2.0. So you 2 times your money, 2x your money. That's another way of saying it. 100% return is a 2 times your money. But obviously those metrics are going to change a whole bunch depending on the investment itself. But we picked some easy numbers here that'll make it easy to discuss. So basically 100% is doubling your money. And honestly, if it at least doubles your money, the investment, then it's a great way to compare it to other types of investment. In the stock market, let's say, it's common understanding that over the long term, you're effectively going to double your money every 7 years in the stock market, according to the historical returns of the stock market. It could be sooner if it's in a peak season where the stock market's shooting up, or it could be slower if there's a drop anywhere between from when you start to get to your doubling your money. But over the long term, if the average out every 7-8 years or so, doubling your money. So if you can do it faster in other types of investments, that's an indication that hey, it's a better, quicker, higher return. Which is a great segue, if I may say so myself, into our other metric that we're going to discuss today, which is the average annual return. Okay, so let's say we have that same investment where we were invested $10,000, and at the end we have a stack of cash equaling $20,000, that 100% return. For the average annual return, we're putting time into there. How long did it take us to double our money to get a 100% return? And in the example we put in the website here, 5 years. Let's say it took 5 years to get back all that $20,000 from our initial investment of $10,000. All you got to do is take that 100% and divide it by number or whatever the total return is. In this case, it's 100 divided by the total number of years that it'll take us to get there. And voila, we have our average annual return. In this case, 100% divided by 5 is obviously 20. That means on average, your investment made 20% a year. Now, it's important to note that this does not mean that every year you got 20% of your investment back to you in cash. In this case, $10,000. It does not mean that each year it spit out $2,000 at you. It may have, but it doesn't necessarily mean that. Maybe it spit out no money, and then at the very end, it gave you $20,000 back. That still equals the same 20% average annual return, but it doesn't necessarily indicate how that money came out. There's other metrics that we'll talk about later that indicate when those funds are coming back. So this is an important way to measure up against other investments or other investment types. I think this is average annual return and total return are probably the best ways to compare it to, especially like the other common investment is the stock market. I'll quit talking for a second, Jordan, let you jump in.
Thinking about this, what really matters is comparison. Right? That's one of the things I like to stress, because these numbers can mean something. Putting aside, say they got these numbers in the most excellent conservative underwriting way possible. Even so, what they really mean is going to really come to the fore when you compare them to each other, and also, like Matthias has pointed out, other investments. So, for instance, when I say compare to one another, a very simple example would be, as he just made clear, the total return of 100% and the annual return of 20% over 5 years, if it was a 5-year investment. That could literally just mean a lump sum at the very end. It could mean just you got 20,000 back. You invested 10 at the beginning of the 5 years, you get 20 back at the end. So the total return, all it's saying is how much you ended up with. It's not telling you how long it took. Average annual return is telling you how long it took, but not at what rate it was paid back, which is, like he said, something we're going to talk about in the next one. So Matthias, I guess what I would ask you is, based on those simple examples of what they mean, what's the most important thing to focus on when looking at these metrics?
Yeah, well, so the idea is to make sure that you can compare apples to apples when you're deciding what to do with your money, because every investment, there's an opportunity cost every time you do something with the money, right? Either you leave it in a bank, sitting there waiting on a new opportunity, there's opportunity cost to not deploying it immediately in something else, right? So what we want to be able to do is say, hey, well, if I'm going to invest in this, that means I can't invest in other things. So we want to compare and make, according to our strategies and what our goals are, maybe our, preservation of capital, long-term growth, whatever our goals are, we want to make sure we're comparing apples to apples when we figure out what the best investment is for that particular goal that we're aiming for. So first of all, just for purposes of this discussion, we'll say, yes, these are all very trustworthy projections that we agree with. And let's say I was choosing between investing in a stock or an index fund or a real estate investment. You would go, okay, what's the average annual return that I'm projected? And assuming I've evaluated that to be a good projection of what's going to happen, then I would compare that to kind of the long term. It's so hard to predict in the future for stocks. You could look up analyst estimates for the next year usually, but analysts don't like to go out farther than that when it comes to stocks or companies. But what you could do is you look at the historical record. Most stocks are going to have pretty high average annual returns, because if they're individual stocks that you're looking at, probably you've heard of it, they're growing at a good pace, that kind of thing. That's a lot riskier because each company is on its own. But let's say you're looking at index funds, which is a diversified way to invest in the stocks. You would compare, let's say, the S&P 500 traditionally, historically, has done between 7 and 8% over the long term, right? So you would say, all right, that's that average annual return. And make sure that whatever metrics you're looking at are including dividends, because a lot of S&P 500 stocks do pay dividends, varying degrees of dividends. Some of them are high yield, some are low yield, whatever. Let's say it's a total return of the stock market. That's what you would look at to compare if you were looking at this, the real estate type of investing that we do versus the stock market. And that way you would use this metric, among others, to figure out if you're comparing apples to apples when you go. And then you have a bunch of other personal decisions to make on that. And like I said earlier, according to your goals or whatever you're looking to accomplish. But AAR is one of the best ways to do apples and apples when you're comparing investments.
Right, because it does take into account a length of time. Even though it doesn't specify exactly when that money's coming back, it gives you a projection of the amount of time.
Right.
And or how much you'll make over each time, right, each year.
Yeah, because some weeks it could be down, some weeks it could be up. We don't know how exactly we got here, but we do expect to be in this general spot after the X length of time.
Which is why you can't really compare total return of even within two real estate investments necessarily, because that may be based on different projections of years.
Right.
And so that's where the average annual return comes to bear, because then you can see if they have the same amount of total return, but then you go to the average annual and one's lower than the other, then you know that they expect it to take longer to get there.
Right. Yeah, and that's the gist of how we look at the AAR. AAR is one of the most common used metrics. Obviously, it matters how and when you get the money back in your return, but that's the best way to compare it to other types of investing. You talk about gold, bonds, whatever it is. This is the best way to compare it to other types of investing. You have a set amount of time, and you have a percentage each year.
And so we haven't really talked about it too much. The equity multiple is definitely just a different way of saying total return.
It is.
Is that just because it exists as a standard one that you will see on an investment summary, just because some people, that's an easier way to understand it than the total return percentage versus multiplier? It's intriguing to me that they're both there, even though they say,
yeah, because some people look at it as, hey, what's this going to do to my money, and how long is it going to take? So effectively, they're asking the AAR. But I've had people literally say, I've said, hey, I've got a new opportunity. They go, okay, what's the equity multiple and how long? Which they're asking for their own interpretation of AAR. And there's a lot of other private equity types of investment, not necessarily stocks, bonds, but private equity type stuff, business, startup, whatever, where they talk in equity multiples in different rounds of funding and ways of talking. So people who do any like angel investing or venture capital or anything like that, equity multiple is a much more common metric than those. So when you're presenting the AAR, the total return, and then the equity multiple, you're able to speak the language of most of the other types of investment that somebody could be involved in or familiar with.
Okay, so good to have that flexibility for sure.
Right, and it's just a different way of saying the same stuff, but you have it in there because, again, there's just some groups or some industries talk different languages, different jargon, so you want to be able to relate 100%. To their specific way of talking.
Not only do different disciplines or sectors talk different jargon, or just use some part of the pantheon of jargon more than the other part.
Right.
There's also just the way that people understand things. Everyone kind of understands things a little bit differently. So I can absolutely understand one person being like, okay, I understand it's doubling my money, way more than like, it's 100%, right? So the 100% can trip some people up for sure. Just percentages, the way that they work in that regard. So just to kind of forecast part two, what we haven't spoken about, which is going to be in the next part, is how that money comes back. Exactly. And how there's a way in which real estate investment does get your money back in a way that nothing else really does, except maybe owning a business, because it is a business essentially. So it's going to be a little bit different than the stock market in that regard, but knowing how that's going to come back and at what rate is not really involved in these metrics, but that's what we're going to get into next time.
Yeah.
We started here because this is the high line. These are where you start. This is the first apples to apples.
Agreed.
So that is the suggestion, I suppose, is when you're looking at investment metrics, you start here first.
Yeah. And then you learn more, and it can teach you, what we're going to talk about in part two. It'll teach you a little bit more about why this might be or might not be different or better than your other types of investing. And there's other ways to compare. And that's why we have so many different metrics, is so that you can compare and contrast according to the goals, like we talked about earlier. Not all investments are good to produce all different goals, right? Like some of are better, safer investments that, preservation of capital, that's all up to you. But our goal is to present you with metrics that allow you to determine what the best way to get to your goals is.
Right. And kind of break that down a little bit. If you are comparing, let's keep it simple, two similar investments rather than trying to bring index funds and analyst projections and all that stuff. What matters more to you, for instance, one that could maybe make you more, but it'll be slower and longer, or the one that'll make you a really good return for the next few years? And there's a decent chance based on projections, you'll have some of that capital back to be able to do something else with, would be.
Exactly. That's what you're trying to compare and contrast with these. But again, the metrics are there to make sure it's apples to apples. So you're looking at the right numbers to compare. But that's exactly right. Like, what your goal is or what you want to happen. The metrics are here to tell you if this would or would not accomplish those goals.
Right. And when you say preservation of capital, I'm assuming you mean lower risk versus higher risk investments. Yes. Okay. And then the last thing I'll note before we get out of here is that typically, if you've not ever seen an investment summary or a pitch deck before, they're going to be in ranges, most likely, or a plus minus. They may put it one of the two ways. And we haven't really spoken about the targets or knowing what's a good range or not when looking at these kind of investments. You did say the stock market, it's aiming to double every 7 years, but
Yeah, I mean, there's industry standards for this as well. I mean, it's hard to say because again, there's different types of investment. Some people just want to invest for preservation of capital, tax purposes, things like that, and so they're not looking for big returns. So big quick returns, I should say. So it's hard to give average annual return. The range could be anywhere from in real estate anywhere from we'll say 13 to 20%. Generally is somewhere where you would expect to see them. But again, that could vary widely based on the strategy they use and the type of investing they're doing. I hesitate to give too many detailed numbers on that just because it's a variable that very much could change. In total return, some of them could be flipping, basically buying and turning over real quick. So your equity multiple and your total return might be relatively small. Maybe it's a 70% total return. But hey, if you do that in a year, that's a 70% average annual return. It's very hard to, just because there's such very different strategies, that the total return and equity multiple could be all over the place.
Sure. Yeah. Of course, we don't want to put too many limits on it, but I would venture to say if they're looking at a syndication like the ones that we offer and someone is guaranteeing them like 35% annual return,
I would be,
that might
get out my microscope to start looking at that.
Yeah.
I would as well. That would be, now I've seen some that have returned that, just right. Home run investments, but anybody who's projecting that is probably living on a prayer, Bon Jovi fans.
Okay, yeah, exactly. So there are definitely outlandish numbers that would lead you to maybe want to ask a few more questions, for sure.
Yeah, sure. Fair.
I guess the other side of that exists as well, where they're like, the annual return is going to be 6%, at which point
I'll just leave it in my high yield with no risk.
Yeah, I don't. Yeah,
I get darn near that.
That would lead to different questions, but definitely also follow-up questions. Okay. Well, yeah. we're gonna get out of here on this part 1 of investment metrics. As always, we appreciate you hanging out with us. And if you have any questions or comments or thoughts, please reach out to us on any of the platforms this is on, or hit us up on the website where you can also find more information about all of this and more. But until next week, when we come back for part 2 of this, we'll say goodbye on the most recent episode of the Get Invested podcast.
See you.